All right. How you doing, friends? It is Wednesday, November 16, and this is 0 Days to Expiration, the final hour show. And today we had a interesting trade on. The market went nowhere, and it was kind of surprising, especially with all this volatility, the news, the wonderment around the Fed. 3 separate Fed governors speaking today, which is rather unusual. Usually that really stirs up the pot. It didn't this time. Really, nothing much happened. We went almost exactly sideways with very, very little range. So a trade like that, or putting a trade on for something like that, really goes nowhere. Um, it it kind of fooled me because I thought, all right, it looked like we were consolidating. We were going to do some sort of pattern, and then we would come down and everything would be cool. And then it looked like the pattern was rejected, and then it wasn't, but it didn't go it didn't go the other way. So basically a sideways day. It comes off into the wilderness, does nothing. So it's a no harm, no foul day, no big profit day. In our case, it was either a very small loss or a very small win. So, you have those days there. A member asked me, well, could you have just played at the money on a day like today? And I thought about it. And I said, yeah, I guess you could. But how would you have known that it was going to be a sideways day to go at the money at the beginning of the day? And the answer is that you wouldn't know. So I guess that goes out the window. That idea. Perhaps you could go at the end of the day or near the end of the day and play an at the money. So what an at the money trade is, that's how most, I guess, other 0 DTE services would and traders tend to trade 0 DTE. And what they do is they put on a very wide iron condor that has a huge amount of risk going after a small amount of profit, but they put the legs on so wide that there's little chance, or small chance, not little chance, but there's definitely a chance that they will violate one of those legs and then achieve that max loss, which can be quite large. And it's a high probability strategy. And on a day like today, it probably would have worked out great. You would have put up about $1,000 so you could make $50. Potentially, you could have stayed in the trade all day and perhaps made as much as $100 or 10% return. And 10% return in that kind of strategy is considered pretty good. Or you could have traded like what we trade, where you would have put up about, in this case, we had a number of different strategies, but let's say that we chose the most expensive strategy, and that was trading the SPX and using a butterfly out of the money. You would have put up about $230, and you would have either made about $125, between 75 and 125, or maybe you would have lost a few dollars. And so that's really the difference. However, we would have had the potential of making as much as $1,800 approximately. But that is if it actually went up and did that. The other trade, the Iron Condor trade, the max you could make ever is that $100. And in most cases, you would take $50 because that's the nature of their strategy. Their rules generally say once you achieve 50% profit, get out. And the reason why they do that is to protect you from potentially hitting one of the risk sides, which can be quite large. I mean, you could potentially lose $900. So you don't want to do that. So those would be your two choices. The one where there's a chance of making nearly $2,000 with hardly any risk, and at the worst case, making about the max you would make in with the other strategy, or take the other strategy, risking potentially making a huge loss or making a small percentage of profit. So to me, it sounds like that's a no-brainer. And from a professional trader's point of view, I always want to take the trade that has the best long-term expectancy, has the most efficient way of using the capital that I put at work, that isn't going to send me off the edge in the event that I am challenging the risk in the trade and have it potentially affect my emotional content. Now you think, well, if you're a professional, then you should have no emotions, as if just because you wear a badge or something that you have no emotions. That's not true at all. You still are affected by that, and you still worry about it, and you have to take evasive or mitigating action, right? But if I can put myself into a situation where I never even have to do that. Now, today, I looked at today's trade, and it looked like it was a sure thing that it was going to go away from our trade. And I very rarely do this. I very rarely take a trade off early and not allow it to go to max loss, because our max losses are usually very small compared to what we put in. But today I felt fairly confident that that's what was going to happen. It was going to just, it broke through a level and just started to go the other way. And I said, let's just stop it right now. And so you lose a few bucks. Not a big deal. And then it returned and reversed back, came back into, like, still on the outer edges of the trade, didn't really go anywhere, and ended up exactly where we were before, just nowhere. You could, at any time during the day, you could have taken, anywhere from 100 to, let's see, I don't even know that if it's in profit anymore, because the profit curve is starting to squeeze in and the gamma risk is rising, and it doesn't look like we're going anywhere. I'll just show you. All right. So we come into the day where, when the market opens, or just before the market opens, we're sitting right around here, and I come up with my scenarios where I think price is going to go. And as you can see, I thought generally that we were going to basically stay in the same area. There was a chance that we might move down. And so because I had this slightly extra bearish bias, I decided that I would take the bearish trade. And so that was right around here when we get into the trade during our Zoom call around 10:30. I thought, okay, that seems like a bearish trade seems like the way to go. So we get in, and price started to go down there, and I'm thinking, oh yeah, I was right. This is going to be a pit trade. And I thought a little bit better. I waited, and it just turned around. I said, oh well, there goes the pin trade. At that time, we could have taken a profit of about, I don't know, $125, or about 50-60% of the risk that we put on. But it was still early in the day. It's only, not even 11 o'clock. And so here we're at a place where we could take the amount of profit that only the other type of trader could have taken at the very end of the day, assuming the trade went right down the middle and stayed within their profit tent all the way to the end of the day. We could have taken this at 11 o'clock. But decided not to, just, wait it out and see what happens, because, who knows? I'm going for potentially 1800, not 100. And so it comes back up, and then it gets to this kind of nowhere zone area, and you can see that we were doing a lot of analysis. I'm drawing a lot of lines and trying to figure out exactly where the neckline is, or where the breakout line might be, and we start recognizing patterns that we see often. One we call the curve, right? And that started to work out, and it started to look like it was going to break out, but then that failed. And then I saw another pattern that looked like a diamond pattern, which is kind of a reversal pattern, and that started to work out, and then it failed. And we're still sitting here right in the middle. And then, a little later in the afternoon, around 1:30, it breaks down a little bit, but then slowly, gradually comes back up to the center here. And again, we're nowhere. Just a few minutes ago, before getting on here, we dropped down a little bit, but by this time, we're still nowhere close to the profit tent. So again, it's just a nowhere trade. So, there's not a lot of use of sticking around for any length of time. Yeah, I'm going to move these microphones a little closer. There, that must be much better. So, so right around here is when someone in the service asked, "Well, couldn't we have done one of those, those at the money trades or something?" And I replied, "Well, if we knew it was going to go sideways today from the very beginning when we first put on the trade, I guess we could have. But nobody knows that. In fact, sideways or just a very tiny range in this market is very rare. It doesn't happen. Maybe 1 out of 10, maybe 1 out of 15 trades that we have this kind of small range and really go nowhere and just go sideways. So, that would have been just a big guess. Our strategy is really to stay well out of the money, get the good risk to reward, and bide our time. And we look for 3 different profit zones. In this case, we have our primary profit zone, which is outside the tent, very similar to this trade here. And while it's staying outside and doesn't look like it wants to go there, maybe there's some support or resistance that's just keeping it there, or it's just, I guess, a sideways day. We still have ample opportunity to take profit. It might not be huge by our standards, but it's certainly a lot bigger than the money that the other strategies get. In this case, anywhere from 50 to 80% return on our money. All right. Now, remember, I said that the other guys, they're hoping to get 10% on their money. They're hoping, but they usually take 5%. So, yeah, that's what happened today. So I have to now follow through with what this whole episode is about, and that is that zero DTE creates pro traders. And so what I mean by that is that there are a number of things that we do in the course of a day that set us up here and give us clarity on what we're going to do from moment to moment. We don't know what's going to happen, but at least when it happens, we're prepared for what happens and then how to adjust to it or react to it. And then at the end of the day, we take all of that information that we employed, because sometimes every day is different. It doesn't mean that every day it's going to be like textbook and if it does A, you do B. If it does C.3, you do D.7. It doesn't work that way. There's always little variations, little differences. The market's different. The volatility is different. The energies coming into the market are different. The way the day transpires is different, but similar to maybe other days. And so we want to learn from all of those situations and the type of strategies that we put on for both entry and then management and then exit of the trade. And what we do is we'll take that, and I talked about this yesterday in yesterday's program, and write it all down. We do both quantitative and qualitative recording of our trade. So the quantitative stuff is pretty easy. That's just the specifics of the trade. How wide was it? What did it cost? When did we put it on, etc.? What were the market conditions? All of that sort of thing. What was the specific strategy? What was the asset that we used? And then what were the results of doing the trade? So that's all the quantitative data, and we can take that and we can analyze it later. Again, this is all part of being a professional and understanding those analytical tools and results help us make future decisions on how we can modify our behavior or our trades or our strategies to get better each time. And then there's the other aspect, and that is the qualitative data. Those are the things, the intangibles that we can't always control. Well, we hardly ever have any control over them. And those are things like, well, what was the trading environment like? Was it, a particularly tumultuous day, or was it chaotic? Was it subdued? Did you have a lot of volatility, a little volatility? Was it changing? So basically the technical environment, what was that like? And so we might rate that, and then there's the trade itself. How did we react to it? So how did we go about employing the things that we knew in the past and that we are trying to optimize, and how did we apply it to that situation? Did we encounter something that was maybe a little outside of that, the known path, and did we react to that correctly? All right. So then maybe the third thing is, what was our mental state like? And so we'll try to do an objective viewpoint of, where we were from a mental point of view. Was our concentration there or not? Were we tired? Were we awake? Anything that we think that might have added to or detracted from that activity that day. And then we'll take all of that information and we will put it down into a journal, and that journal for each day would comprise what we would call the playbook. And the playbook is something that, our journal isn't just like a diary where you just put it in there and then you forget about it. Our journal is an active document. It's something that we use. Let me go back to, because I'm talking with my hands. So without you seeing me use my hands, then you can't fully understand exactly what I'm saying. So it's a journal is unlike a diary where you just write in it, and maybe years later you look back at it and you get nostalgic. We use our journal in an active way to be able to close the loop on each week with what we call our continuous improvement process. And after, week after week after week of doing this and then compiling that data, sometimes it takes 2 or 3 months before you have enough data to be able to start seeing patterns of behavior. It's very difficult to see a pattern of behavior if you've only done it for 1 week and you look back at 5 trades and you say, okay, I've identified something dramatic in Ernie's behavior when when this kind of situation comes up. When that situation only came up once. But once it comes up 2, 3, 5, 100 times, and you can compare all of those times and the emotional content and both the qualitative and quantitative data, put them together, and then start making correlations with the results, you can start seeing patterns of behavior and the results of that behavior. Then, if necessary, you can take corrective action, like maybe you saw a habit that's starting to develop and it's a bad habit. Or it could have been a good habit. If it's a good habit, then you want to encourage it. But if it's a bad habit, then you want to be able to mitigate that bad behavior and get you back onto that pure process path that you want to be on. So that's the purpose of the journal. And then the playbook that evolves from that is really important. The playbook is really our recipe book. The things that bubble to the top that end up being our best plays. And we want to be able to repeat our best plays when we have that opportunity. To be able to learn from, the 10 trades that we did over the past 6 months that just produced extraordinary results because we did this or did that or didn't do this or that. And so we want to have that cataloged and qualified so that when we're in that situation, then we can refer to that while we're trading, even say, hey, this situation's a lot like this, right? And and then you pull that up and you said, I did this or that, and does that apply here? And maybe you can learn something from it. Maybe you can apply that same thing, and then it benefits you. So everything that we do is this re-injection of the positive things that we've done to try to make them better and better. And if there are negative things, then we try to employ behaviors that will get us back on track so that we can continue doing that positive stuff. So that's basically what a professional does. And that's like the big process. But then there are so many other things that are that we do that help us stay on that path as well. And probably the thing that is, I guess, most overlooked are some of the little things that you do. The things that you do in the course of your day leading up to the trading and while you are trading, the behaviors, the things that you do to to clear your desk and clear your mind and clear any kind of distraction. The mental state that you get in when you start right from the very beginning, because if you come into the day underprepared, not only from a technical point of view, but also from a physical and a mental point of view, you're putting yourself at a disadvantage. And so you need to be at top physical and mental shape when you're doing something that has a lot of moving parts and quite frankly, a lot of complexity. And you want to simplify it as much as you possibly can so that those things don't overwhelm you and cause you to make bad decisions. Because bad decisions is bad. Good decisions are good. And so that's where we would rather be. So anyways, I've been talking about these concepts for a long time in the service, and hoping that people will take my example and then they'll do those things, and a lot of people have. But I think what we're doing now is we're formalizing it more, and compelling people and maybe gamifying the whole situation by providing a way that they can create these journals and then share it with everybody else, or playbook is a better way to put it. So each time that they complete their journaling, which is a page in their playbook. See, the journal page itself, that is another page in the playbook. The playbook may have all of the journal pages that you've ever created, or only some of them, or only the top 10, or whatever that is. But the playbook is meant to be a place where you categorize, collate, and sort, and promote only the best trades so that you can then refer to those. And maybe, your worst trades, maybe that goes in a special section so you can understand also the times that you didn't do so well. So we've created a special channel inside of our Discord where everybody is going to submit their plays. Now, whether or not we can get people to actually do that on a regular basis, that remains to be seen. But I think that once a few people start doing it, and if I'm doing it on a regular basis, then people will get, hey, this is what you do. And this is what you do if you want to become a professional trader. So that's what we do. And if that's something that interests you, go down to the description there and give our service out a try. 0-dte.com/try. All right, now it is time to do the roll call. All right, and see who's there. And so, by the way, today will be our first day because I just created the journal last night. Not the journal, but the playbook channel. And I provided, some guidance on what that will look like. Some people have already started creating their own plays or their own journal page that they're going to upload to it. And the way we're going to do it really is perhaps, the best way, I think, is it doesn't have to be really super verbose or anything, but there are certain questions and things that you should cover that describe everything that you did and the result that you got from that. And maybe a graphic that shows the annotations and the descriptive part of that, whatever's necessary. 1, 2, 3 graphs, maybe 5 or 6 bullet points, maybe a short narrative, and then describing the specification of the trade, and put all that on a single page. And I think that using something like Keynote or PowerPoint are the best way to do that. And then they can export that as a JPEG for that page, and then upload that um, to the channel page, to the playbook channel. So that's exactly what we're doing, and that's starting today. That's going to be exciting. I mean, I've been doing something like that, but really my content goes all over the service. So now we're going to have this one place where everybody is going to share their own journal pages, and hopefully we'll get everybody engaged in that, and as many people engaged in that. I think that it will become a momentum thing. And once people come into the service and see, oh, this is the way we do things here, and they will do it as well, and then they will gain the benefit from that. Now, there are a lot of other things that are very different in our service from other services. And probably the biggest is the level of attention that each individual member gets. In fact, when you become a trial member here, and our trials are for 4 weeks. When you become a trial member, you book an appointment with me. And it's not an insignificant booking. I mean, we sit down and we talk for 45 minutes to an hour so that I can learn as much as I can about you, and you can learn as much as you can about being as orientated and efficient with the system and the way everything works here when you first get in here, so that your trial can become as fulfilling as possible, so that you get the full effect, that you're not left sort of hanging. And I'm not aware of any other service that does anything like that, and particularly not for the price that we charge here. For something like that, I would say that that would be a professional level service that you would probably rightfully pay $5,000-$10,000 for it to be involved with, right? And we do that at just a small fraction of that. But that is my goal, and is to help every single person and drive every single person towards becoming a professional trader. And not only learning the strategy, the methods, and the process, all of that all together, but also learning the skills that you need in order to stay on that process, right? So there you go. All right, so now I'm going to go to the chat and do our roll call, see who's showed up today. Let's see, we have Rob Fresno. How you doing? We have all the usual suspects. We have greetings. Oh my God, what happened? It's not greetings, or hello, or hey ho, or hello squared. Giannis is here. How you doing? And Jim Seraphin, nice to see you. Well, see, Jay Hen has taken over for Is. He's saying hey. And Brent is here. Maiko, how you doing? Let's see. Giannis has something to say. He says, hey, Ernie, does it make any sense moving the long options some days out in time while keeping the shorts at 0 DTE? You could call that a double call diagonal. Would that benefit the overall theta? My only problem with something like that is management. It's a much more complex trade. And I don't mind a double diagonal, but I think we can look at that as an alternative strategy that we can explore in the same way that we do any kind of alternative strategy here. We go through what would you call it? A curation process. So all of our strategies go through something like that. We ideate, right? Come up with the ideas. We then create our hypothesis around that trade, and we all talk about it, and then put it into a curation where we'll actually try it and garner and gather all the information in much the same way we did with the final hour trade that we did for, I don't know, almost 100 episodes, and then decide whether or not it's something that we want to go forward with. So that's what I would want to do with something like that. But before we actually engage in it and expend that kind of energy, I want to make sure that it would be something that everybody would feel comfortable with. I mean, as it stands now, we only focus on a rather narrow range of butterflies and variations of that, but it's still very flexible. And I think that there's a lot to learn in just that simple arrangement. And now we're talking about potentially bringing in the micro version of the SPX and others to help do some form of delta or gamma hedging on that. That's another level of complexity. And so we're going to go through that same sort of process with that. So if you have an idea like that, then submit it, and then we'll all talk about it and see if it's something that we want to spend our time on. Hopefully that helps. All right. And we have Jonah. How you doing? Oh, misspelled hello. Hi, real P&L. Carl, how you doing? Thank you very much. And we have Tim Dodds. Howdy. We have some chatting. And Donald Steele, nice to see you. Dexter, how you doing? Carl James, nice to see you. Ray, how's it going, man? And Rob Boblega, I'm telling you, you can't say that 10 times fast, no matter what. Jay Hen says, I would think that the overnight risk could change the short side ODTE altogether. Well, that's one thing that we try to avoid altogether too, is just the overnight risk. You know, why bother? And everything that we do is all about defined risk and that asymmetry. So that's kind of like the core of what we do and what gives us the edge. And it's what, you know, I've seen as a positive way, as a proven way to work in a wide range of financial and other types of pursuits. So I would want to follow through with that same kind of underlying philosophy. So everything that we do isn't just about putting on a strategy and then seeing if it works. It should also have some sort of underlying philosophy to it, a set of values that you try to promote, right? So that every decision that you make can be put up against those values and that underlying philosophy and see if it makes sense. So there's a lot more work to do than just putting something on like that. It really needs to answer a lot of different questions, and whether or not there is a underlying philosophy and edge that we can all stand behind and really understand. All right. Okay. Thank you, Boblega. Thank you. I'm still saying that Rob Boblega. You can't say that 10 times fast. He's gonna try. Fresno and Clovis, basically the same town. Is that in California? That's obviously in California. I don't know where Fresno and Clovis are. I've been to Carlsbad and to Newport and La Jolla and San Diego. Well, of course, many years ago, I was in LA and then drove up the coast. So. All right. Okay, cool. So we got our roll call out of the way. Thanks all for joining me. It still looks like we're not going to go anywhere near our trade. It's going to stay on the outskirts. So there's really not much to do. Like I said, there was plenty of opportunity to make profit, and it's one of our 60s. And what I mean by that, and you've probably seen this if you've been watching for a while, we tend to chop up our profits or opportunities in 3 separate groups. As a general rule, our type of strategy is relatively low win rate, but high return. And so let's say that, let's just say for argument's sake that it's a 50-50 win rate. 50% of the time you lose, 50% of the time you win. So we're only interested really in those winners, because the losers are very small, they defined risk, and they don't really bother us. So we're really focused on what those winners are so that we can offset those losses and then also have positive returns from there. So what we found was that by employing our strategy the way we do, with the risk to reward that we take and the width of the spreads and the process that we go through, those winners tend to get distributed in a 60-30-10 makeup. So 60% of the wins that we get are usually outside of the profit tent, and that would be, exactly what we're seeing here today. That would be one of those 60 percenters, right? And those winners usually result in anywhere from a 25 to 150% return on the risk that we take. And like I said, our risk is very small. We're usually going for a highly asymmetric trade that is typically, 1 part risk to 7 to 10 parts reward. And so our returns, like I said, for 60% of those trades are between 25 and 150%. They tend to offset all of the risk, all of the losers that we take. And that's about 60% of them. And then about 30% of our winners are anywhere from 150 to 250, 300% return on risk. So imagine if we're taking a $200 trade and most of our returns are somewhere between $100 and $300 for that 60%. And then the middle tier, which is about 30% of our winners, that is anywhere from 150 to 300% return. So anywhere from, say, $300 return per fly. And then there's the times where we now the 30%er is inside of the profit tent. The 60%ers are outside. So when you're in that outside, you don't want to let them go. You don't want them to just go to a max loss. If you have profit, you want to grab them, because those are the things that are going to offset the losses. And then about 30% of our wins are those mid-tier wins, and those will tend to elevate your account. The 60 percenters will keep you level and maybe a little bit up, like this. They're the things that keep you from having any significant drawdown and also having very little volatility in your equity curve. The 30 percenters tend to rise you up, and then the 10 percenters kind of leapfrog you. So our equity curve tends to, be something like this. It will go sideways, up, sideways, up, sideways, up. And usually those sideways events are, you just hit tough times in the market, but we never really go down. So for instance, my drawdown so far with this account here is about, max drawdown has been about 3.25%. Last year, my max drawdown through the entire year was only about 4.5%. Took a lot more risks last year too, but also did a lot better. And also it was the market just went straight up, so it wasn't particularly hard to trade. This market this year has been extremely difficult, but still managing about 5 to 7% return per month, so that's good. But we have these sideways times, and so you have to make sure you take those small wins, like today. Today would be a perfect example. If you don't take that $100, even though it's only a 50% return on your risk, which to a lot of people will sound like a lot, but to us that's at the very low end of our return scale. Then that means that you may potentially go to a max loss, and then that's a big turnaround. That's a big flip. It's a big flip. Imagine if it's a $200 trade, and you had taken the 50% return, you would have had your original 200 plus 100 in your pocket. If you didn't take it and went to max loss, that would be $200 out of your pocket, right? That's a $500 swing. I mean, you don't want to do that. That's crazy. No, that's not a $500 swing. Is it? Yeah, it's a big swing. So so that you want to take those small wins seriously and concentrate on those. As a matter of fact, you should be putting more concentration on those than the others, because the others tend to happen. They tend to come in. And then it's just a matter of managing your gamma risk and see how far into the day that you can go. And of course, the further you can go into the day, then the higher the odds go that you could potentially get a pin trade, which could give you one of those mammoth outlier wins. And those can be, tremendous return, making 500, 700, 1,000, 1,500% return on your risk. And again, like those are the things that they don't happen as often, 1 out of every 20 trades or so. And those are the things that are going to propel you. But they're not things that you should be waiting for every time, right? So in the beginning, a lot of people would take this strategy and they would see us get a pin trade and they want to get a pin trade every time. And so they're holding out, and not realizing that they only come across about 10% of the time. It's not that often. And instead of taking their small profit, they allow them to go to max loss, and then they're all dejected and saying, lost again, when they could be winning, and stay right on an even keel and never really allow those things to bother them. So that's a big difference, really big difference. Let's see. Everyone's waving to each other in the background. Jahan says that I would think that in the overnight risk could change the short side ODTE, 0 DTE altogether. The overnight risk could change the short side. Well, I mean, what you're really talking about is a kind of like a straddle strangle swap, right? So the long trades would persist, and they would be your bullish, your bull strangle, right? Or a long strangle. And then your short strikes would be a straddle, right? And so you're constantly rolling the straddle inside of a longer strangle. I think that's what you're talking about. And I mean, that's a trade that I've done, in the past, with, much larger money. And it's a viable strategy, but I would say that the mechanics of it and the rolling are quite a bit, and also the upfront initial cost, and also in the course of the swap or the roll, all of those things can exact a great deal of margin. And so it may not be for everybody. It might be a great idea, but I think for most people that are coming into this that have small to medium size accounts, anywhere from a few thousand to maybe a couple $100,000, those aren't trades that they're going to want to do all the time, or learn when they can learn something else that might be quite a bit more sanguine and easier on their constitution, and make really good money and not have to worry about all that extra complexity. However, once they get really good at that, then they're going to want to expand into different things. So I can see adding that. But like I said, I have other strategies that I think that are that will give you really good other opportunities that we could follow that are even simpler than that, like the hedging. And so we'll look at those too. We'll look at it. Carl says Central CA. I've only passed through Central CA, California. That was a long time ago. I remember we went down to LA for business, and then we had to run up the California highway. I forgot what number it is, but all the way up to Seattle for our next meeting. And so it took us a few days to get up there. And that was really cool. I remember the thing that the beauty of going up the coast is unbelievable. But the thing that blew me away mostly was we went through certain towns where there were lots of oil rigs and lots of houses that had oil rigs in their front yards. And I thought that was nuts. That was crazy. It just never occurred to me. And these days, they're probably all sealed up and gone because everyone in California looks at oil as if it's the devil's blood. So who knows? Maybe they're still there. So Jonah says, and less stressful than the credit spreads I was doing before. Can trade in the morning, work, do other stuff, just let it run till close. Yeah, it's one of the nice things. So let's see. Carl's asking, is max drawdown from peak to trough? Yes. Yes, absolutely. He finally got it spelled right. um, so, I mean, I can show you if you want, but I've showed it many times. And you can go on my website and you can see it. Landon, how you doing? Thoughts on covering a ratio spread after a risk-free trade is available? Rinse and repeat. Well, see, a ratio spread is, again, one of those trades that, well, I mean, there could be undefined risk on that, or you could have defined risk, but you also have this kind of bucket of worry that you're hoping that you're going to move fast enough to get over that bucket of worry and into the profitable area and stay there. And if you don't, then then you left managing that and potentially having a really big loss. So a ratio spread would be good if you felt like you had a good handle on it being a really strong trending day. But again, I am more inclined to do strategies where our risk is extremely well defined, and then there's never really any worry at all, ever, no matter what happens. And so that's kind of like the principle that we operate under. And I mean, even adding the delta hedge or the gamma hedge, while it might alleviate risk on one side of the trade, and that might be a good solution to try to manage even the downside. It creates risk on the other side, and so if we have one of these reversals, then you could potentially have a big loss on the other side of the trade. I mean, it might be a rare event, but that is one of the hesitancies of even doing something that's much simpler, where the ratio spread, I think there's a higher chance that if price doesn't move the way you thought it's going to move, then now you're into a risk situation that you have to manage and be very careful about managing it. Let's see. JD says, how often do you let those flies expire at the end of the day, or do you always close them near the close if the price close is close to your short strikes? Well, because we're trading the SPX, we don't have any assignment risk, and that's not a problem. And in fact, if you have a smaller account, you would prefer to let it close at the end of the day. Then you don't get a pattern day trader strike against you. So we would be much obliged to let it expire right in the end of the day. But if it is, you also have to consider that when you're at that end of the day, your gamma risk starts increasing dramatically. And so if you're not sitting very close to the center strikes, then you have to be diligent about, what's a good time to take off that profit. Because a move 5 points, 10 points in either direction could be the difference between making, say, 150% and making 800%, right? So you want to be really, really careful there. So we employ different types of tests that we do as the day goes on, which is basically squeezing in our the point at which we want to lock in profits. And we lock in profits one of two ways. You can either just close the trade altogether, or you can put on an anti-trade, what we call the PDT hack, and then lock in the profits that way. that way. So, for instance, if you had a put fly and you were sitting there with, I don't know, $12 of profit, you could put on the exact same um, strikes on a call fly, but instead of making it long, you make it short. And when you put that on, it will lock in that profit at $12, and then you can allow both just to ride into expiration. So the cool thing about that is that it's a little bit, I mean, it might seem a little more complex and it takes a little bit of margin, but it's once you get used to it, it's an easy way to do, and you might be able to control um, your spread and the price that you get a little bit better. So those are, and plus you won't get a pattern day trader strike. So if you have under a $25,000 account, then you don't have to worry about that. So that's what I would do. I would so when it's getting near the end, we're not now there are cases though when in some things that we trade like the E-mini S&P, you don't want to let those go to expiration because unless you're prepared to potentially, if you're in the money with any of those legs, taking on an E-mini contract, which means that you have to have the margin to be able to support that, and also you have to be able to handle the potential movement of an E-mini contract because it's so highly leveraged. Just a small movement one way or the other could result either in a credit or a debit to your account. Of course, the credit would be wonderful, the debit wouldn't be so wonderful. So for those, we tend to get out of them before we let them go to expiration. So it's conditional. But how often might be the question, the real question. The real question is how often do we come across like what we call a pin trade or those 10% trades that are near the center strikes. And that's what it is. It's about 10% of the time that we hit those. In other words, about 5% of all of our trades, about 1 out of 20. If you're talking about 10% of our winners are those centers within say 5 points of the center strike. And then based on how far out of the money we put the spreads and so forth, that's usually about the odds of getting to that center strike. All right, Real PLNL, he says, I knew you did. I just asked because some don't use peak to trough, and it's not used. It can be deceptive. Ah, thank you. JD, whenever I can try to take a paid for butterfly into expiration pin trade account changer. Yeah. Yeah. If you're there and you're on the SPX and you're within a few points of the center, man, you want that to go there because, and it's amazing in the last 5 minutes, you could be sitting there with like an $800 profit and there's 5 minutes to go. And if you're right on that center strike, you want to stay in there because you could be adding another $400 or $500 to your profit in that 5 minutes. It's crazy. But at the same time, and this happens a lot, like when there's just a few minutes to go, all of a sudden price will just make this drastic drop or go way up and fall outside of your profit tent. You want to guard against that as well. So you need to have a trade staged, ready to go, just in case. Rob says SPX or XSP. Well, really, the only difference is the XSP is the micro version of the SPX, or 1/10 the size. It also has a lower liquidity, and so the bid ask is a little bit wider. So you're not going to get exactly what you want or as quickly as you want with the SPX. However, for the cost, man, you can put on super wide spreads, and so you can change the whole character of your P&L curve. Now, instead of being this really tall and gamma risk laden trade, it could be super wide and flat, and so you can get into one of those trades and not be as worried about those end of the day movements. So that's one of the advantages of the XSP. Plus, you're paying a lot less. Let's see. Rob Hill, how you doing? Not sure about others, but Tastyworks charges $5 exercise fee on XSP if expiration in the money. Yeah, and also on SPX too. So yeah, that's a problem with Tastyworks, and there are other reasons why I don't trade with Tastyworks. I prefer Thinkorswim, and I'm sure that there's somebody out there that has a better trading platform for trading options at zero DTE, but I'm not sure what it is because I've traded just about every single platform there is. Maybe TradeStation, but yeah. All right, let's see. Where are we? It is 3:57. Oh my god! And we haven't even talked about what's the close going to be. All right, we need your guess right now. We only have less than 3 minutes, less than 2 minutes. Hurry up to get the big prize. I'm going to say it's going to be 39.70. That's my guess. So whoever's closest gets the big prize. What is that big prize, you may ask? Is it that? No. It's not that. Okay, Maiko says 39.65. And so I said, just have to check here. I said 39.70. Yeah, the gold coin. I always have that on hand just in case. There it is. An American Eagle. You should be buying these. You should be buying those. I've been talking about this now for a month and a half. Start dollar cost averaging into gold. I don't know if we've come near a bottom yet, but I think we have. But now would be a good time, and that's already paid off recently. All right, Chona says 39.64 for the SPX, which is about an 8-point. You have to add about 8 points onto that for the E-mini. So my guess is the 39.70 on the E-mini, which would be about 8 points less, or 39.62. There it is. All right. So Jayhen wants to know, no silver? Well, I do have lots of silver, but they're all in very rare investment quality coins, mostly old Morgans. Highly graded Morgans, usually MS66 or better. So I have, yeah, that's the kind of silver, but I don't have any bullion. I sold all my bullion. Oh, when was that? That was I think it was in the winter last year, about a year ago. And I bought a really big safe to hold all the other stuff. Yeah, so no silver. Did you share your vendor? What do you mean? Did I share my vendor? What does that mean? My vendor for what? Milo says, I think silver is actually a little bit more attractive than gold, but I enjoy both. You mean just in its aesthetics? I mean, I don't know. There's something about. I mean, I have a bunch of rare gold coins too, but the silver stuff is really nice. But as far as holding it as bullion, I think gold is just way better because you don't have to hold as much for one. Yeah, you like the hat? See, zero DTE. I will have merch available someday soon. You'll be able to get one very soon. And look at You didn't see the shirt. See the shirt? I've been trying out different vendors and trying different things. Oh, where do you get your gold? I get mine from, it's called goldmetals.com. Is that what it's called? I mean, I've bought from all of them. You know, JD, is it JD Bullion or JB Bullion? AppMex, but I'm pretty sure it's called goldmetal.com. Let me just check. I have kind of like a monthly thing. No, that's not it. I don't know. It's, I forgot what the name of it is. Let's see. Jahan says potential percent gain on the silver for me. I don't know about that either. You might be right, but you know, to tell you the truth, the rare coins have a much better appreciation value than the bullion. Way better. Way better if you know what you're doing. Yeah, the merch is coming, Milo. Yeah, SD Bullion. Yes, I've bought from them. I've bought from AppMex. Oh, I think it's called Money Metal. Is that what it is? Money Metal? Yeah, moneymetals.com. That's it. Yeah, let me show you. I don't know why I couldn't remember it. These guys, I'm on their monthly plan. But don't buy anything but American Eagles. You're going to get the best value. Yep. Yeah. American Eagles. The $20, the $20 gold piece, the full size 1 ounce coin is the best way to go. The others have too much premium in it, and right now, if you were to go to Silver Eagles, the premium on those are ridiculous. They're like $12, $13, $14 right now. That's insane. I don't know how you think that there's possibly more value or more upside for that, because you need to increase by 40, 50% just to get over the premium. And the dealers, when price goes down and you try to sell to the dealer, they're not going to give you any premium for it. As a matter of fact, as little as 2 months ago, if you tried to sell silver, a lot of the dealers wouldn't even give you spot price. Right? I mean, what good is that? With gold, you can always get spot plus 1%. And with some dealers, depending on what you actually have, you might be able to get a little bit more. And when you buy it, you never pay more than 5% premium on them, ever. Of course, there are ways to get it even lower. So American Eagles and American Buffaloes are the way to go. And also with silver, you ever try to sell a Philharmonic? Or even a maple leaf, a silver maple leaf? They are hard to get rid of, and they will not give you anything over. As a matter of fact, you have to take under spot price for those. Unless you have an American Eagle, then they might give you a little bit over, but now they'll give you a little bit over. But just a couple months ago, they wouldn't even give you any premium on the American Eagle. So I disagree 100% on the silver. I've bought and sold enough silver and to know, what I can get versus what I pay for it. It's never been a good deal for me, ever. other than just holding its value and then being able to turn it into cash. That's about the only real value I ascribe to silver. With gold, I just hold on to it and buy it when it's low, and then if I need some cash, I can turn it in, and I never get screwed on the premium ever, ever. Um, so these coins are also legal tender. Well, yeah, they're made by the U.S. Mint. It's a $20 gold piece. It says $20 on it. I think it says $20. I can't read them. The light in the glasses suck. But the buffalo, I think, is a $50 gold piece because it's pure gold. This one here is 90% gold and then 10% silver and copper. Yeah, I don't know what you mean by a hedge for you. I used to think that way. I used to think of metals as a hedge against inflation and that sort of thing. But you look at inflation and you look at the current price, it doesn't seem to have any correlation. I just look at it as a way to store value, right? You make a bunch of money, put it in gold. As a matter of fact, if I could get people to pay me in gold, that would be awesome. That would be my dream. Pay me in gold. Yeah, but Michael, who cares if that's who's going to spend $50 gold piece for $50 worth of product? That would be dumb. It's just a token amount there. They used to be that way. I mean, a $20 gold piece of St. Gaudens like this used to be worth 20. That was $20. People carried this around in their pocket and went and paid for like a good suit or something. Yeah. So what's the point if gold underperforms inflation? The point is it's a great way to store. Well, it doesn't underperform. I'm saying that the change in inflation and the change in gold don't correlate very closely in time. Over time, they do, right? But it's a great way to store your money. I'd rather have my money in gold than have it in dollars sitting in the bank. I don't trust the bank. I don't trust the Fed. I don't trust the government. But with the gold, I trust. That's the difference. It's a way to store your value. The value that you create in the world, you put it into this, and it's like all stored up in there. All that work, hard work I did, it's in there. It's right in there. And I can say that about the rare coins too. Yeah, definitely, way better than paper. The rare coins are a very special case. You know, I'll bring those out next time and I'll show those. But I think I'm running over right now. The wife is probably going to come down here real soon and say we got to go walk the dogs. So I want to say peace to you all. Thank you very much for showing up, and we'll see you tomorrow with another trade in another final hour. Now it is time for the music.